So there's the technology aspect is another part about it. Then, go ahead.
Oh no, I was going to ask. So one of the things I was foreseeing being a big issue with implementation of this is you've got all these hedge funds, family funds, etc., that are doing their naked short selling, getting their FTDs to T35, and then swapping them away suddenly to avoid having to close positions, because we've seen with these swaps that when you trade them with someone, it resets the T35 clock and they bounce around like hot potato. So are we seeing, we see it like go to some weird firm in Brazil, then bounce halfway across the world to Singapore and then back again. Are we seeing anybody stuck holding these things right now as the music stops? Because they can't provide the collateral to do the next trade.
Yes. So that's what's gonna happen, right? It's gonna be somebody who's gonna get caught with their pants down. And again, this is not moving at like some rapid pace, right? And I'll be honest, like this is what I believe to be true, that you are not going to have, like, let's say you fail to meet your margin requirements, right?
Yeah.
And you're a smaller firm. I don't think that you're going to have somebody. Well, you are, but I mean, I don't think that they're going to come, bash your door down and be like, your business is done.
Yeah.
Right. They're going to go through and they're going to look, okay. Well, now it shouldn't happen, right? Because they should have high quality collateral, right?
Yeah.
Technically, they'll just liquidate your ass and you'll be gone. Yeah. Like you'll just get vaporized, right? But I also think that there's going to be a level, because this is all new. I do think that there's a some level of leniency, that not saying they're going to let them off the hook or anything like that, but I think they're going to be like, hey, you need to figure this out, because if not, we're just going to take all your shit, all your collateral. You're just not going to get it back.
I think also there's a fear of liquidating, because if they liquidate one of these guys and they are on 1 to 30 margin because they're maxed out, and that's why they're getting margin called. And they have $1 billion in assets and $30 billion in liabilities. If you liquidate them, cool. You got $29 billion to go.
Yeah. Well, see, and that's the thing too, because I think that especially when you talk about like these total return swaps and everything, because again, what I'm doing, once you and I engage in a swap, and let's say I'm taking some equity on the other side of the swap, you're getting your fixed rate. We're doing a total return swap, right? At that point, I could take that security, as long as I'm making my payments to you. Yeah. I am free to do whatever I want with that, with those assets, right? I can do whatever I want. I can modify them. I could, I could take a short position. I could loan them out. Yeah. Right. I could do a lot of different things, and you don't really have a whole lot of say in that, as long as I'm, paying you your fixed monthly rate.
It's like buying a Honda Civic with a car loan and then just absolutely ricing the thing out, and the bank goes, oh, Jesus Christ. Like,
well, that's exactly kind of that's a really good explanation, right? Or, and I use this on my Twitter, is like, you swapped a bike, right? And that person made a bunch of modifications to their bike, was going out winning races, like racing for money, for pink slips with the bike, but winning money. All of a sudden he did lose the bike, though. That's the same type of shit. Also, though, you have, if you've got somebody that's doing that, right, on the swap end, they're taking the equity, they're doing some crazy shit with it, they're loaning it to somebody else. Now that person's going out and getting leverage on that, right? So now you have like a snowball where it's like everybody's in this, and that's kind of that's the issue that we're in.
Fractional banking in a nutshell. Yeah, that's
that's what it is.
Yeah. Someone deposits $10, you can take 90% of that and loan it to somebody, right? So there's only $1 left. And that $9 gets loaned out to someone. They take that $9, deposit it, and then 81 cents gets lent out, and so on. And it just works its way down. And all it takes is one person needing $11, and everyone's screwed.
Well, that's basically that's what I think is going to happen. That's what I think Phase 6 is trying to prevent. I just think that you won't be able to play. I think these smaller firms are not going to be able to source the collateral. And in a perfect world, what I think happens is not even so much margin calls, what people want. I think so much people, they love that term. They love margin calls and things like that. I just think that these guys stop participating.
Yeah.
Like I think that they just I think my camera just went out. I'll have to fix that. I think they just stopped participating though,
Yeah.
right? Like they're just not they can't afford to do business in the OTC derivative market anymore. And
they've got the velvet rope and they're on the other side of it waiting and hoping maybe
they'll
someday
have to go and take their business elsewhere.
Exactly.
Hang on, so let me get up and unplug my camera. It's sitting up on the other side of my desk. Give me one second. Oh, sorry.
All right. We got a lovely shot. Random picture from 2022 just in a tank top going.
Oh, really?
Yeah, it just popped up.
I don't know what, it must have been on the card or something.
Yep.
Okay, so let's see here. Now we've got let me see where I was at here, because I had a couple of notes. Oh yeah, so I wanted to talk to you because I did want to stress this too. So we have the technical aspect, right? The actual infrastructure of building that infrastructure, the cost to that, right? Which again is putting stress on these smaller banks, right? Because it's expensive to do.
Yep.
But another part of that is the actual lawyer that they have to hire that can negotiate these contracts, right? So you have to put somebody on retainer. You have to, hire that understands like is the law, right? So that's a whole other.
And then there's the commission, and
exactly, and really, so you're introducing a lot of different parties, and again, this is not something these smaller firms are prepared to. They've never had to deal with this.
They're going to be happier just to be like, well, I guess we're just not going to do swaps. I have to figure out a different way to shuffle this stuff around.
That's pretty much what's going to happen. That's what I think is going to happen, right?
Yeah. So I see, if that's the case, like this giant balloon we had in margin during COVID, the numbers were ridiculous. Like in 2020, they went from 1 trillion to like $7 trillion in margin that was being spread out. And that was a lot of retail investors too, playing with margin that they just discovered they could do in their brokerage apps. But if all of a sudden that liquidity disappears, then the only way we're going to have the market stay up here is through stock buybacks. And a lot of those stock buybacks are being funneled through corporate bonds. So if they can't get the corporate bonds, they can't do the stock buybacks, how is everything going to be shored up?
Your guess is as good as mine, brother. Like honestly, that's the one part of this. But I think that's kind of circles back to I think what everybody's saying is like, this is not lining up, right? I mean, and we could see this right now from a mile away. So there's going to be, I think, some level of there'll probably be some firms that are okay that I think are prepared or have bigger people that are following them, because I think again, how we were talking about the beginning of the show, that some of these smaller banks, how it can trickle up. I think that some of these banks will try to ensure that, if it's going to affect their bottom line, they're going to try and make good or try and at least assist some of these companies so they don't just
we saw that with JP Morgan and First Republic. Like they've just been dumping money on them, hoping to save them, because First Republic was like SVB, like 80% of their deposits were uninsured. So if there was a run, that's that. Like they disappear. Okay. Let's talk reverse repo. So we know the banks have a couple $1 trillion in cash that they've been told don't play with that, and that's kind of leading to some liquidity crunch we have right now because we're trying to reduce inflation. But the banks keep getting more cash because they're putting it into this reverse repo with the Federal Reserve and getting 4 or 5% back. So it just keeps growing, and they have more participants.
The thing is too, it's like the banks are actually pretty like at the point when I was really learning about the reverse repo is like, hey, look, the bank's got a lot of cash at this point. And they're not going to keep they'll take funds that will come in and they will push them and they'll say, hey, go buy T-bills, go do this, go to money market funds. But the problem is, because what they want to invest in is something that's the money's going to be secure, which is T-bills, right? Yeah. But the problem is if people can't get them, where do they go to get T-bills? Reverse repo, right? That's where they can go and get them. So I think that banks are flushing people to, they're pushing people there because the banks don't want to take on any more cash at this point too, because the more cash they have, that it starts affecting the insurance on everything that they've got rolling. So they're in a unique position as well, and I've been paying attention to repo. I used to pay attention to it like daily, where it was like, that's all I was focused in on. And then I'm just like, okay, there's so many other, there's just a lot of different pieces that are going into this. You know what I mean? You can kind of get lost in the sauce.
Yeah. And so we've sort of a battle going on, I think, at the Federal Reserve level, where we're trying to keep this cash from going out by using the reverse repos of the banks, because we just gave them too much during COVID. And then on the other side, they're desperately trying to keep the market as like trading sideways as possible. They want that SPY to stay at 400 and not change. And so we see like the plunge protection team buying up securities. And when the banks dropped in March, we saw that climb again. They're like, oh, we're going to do this quantitative tightening. We're going to sell off our securities, and we're going to, bring the price of stuff down. And then it went too quick. They went, oh shit. And they bought up a whole bunch, and they pop back up over $8 trillion again. And so we've got it's like they're speedballing the entire economy. They're taking their uppers and downers. And I don't know what their end game is. Like, you can't have a soft landing if you just like crash into the side of a mountain. I don't know like if they just have two different sides doing two different things, basically battling each other, or if it's a concerted effort. Yeah.
To be honest, I mean, here's what it is, right? Like, see, when you have such large scale use of the repo operation, like just repo period, like you have
bonkers compared to anything else I've ever done before.
Exactly.
Yeah.
But a lot of it too, I think when there's a lot of activity in there, you kind of create like you're creating artificial demand for basically like government securities, right? Like short-term stuff, because people are just trying to put their money in the safest place where it's not going to have too much, issues.
Yeah.
And then they rely heavily on like short-term funding too, which encourages banks, to be like, because they're so scared of what might happen in the market, like any sort of market shift or condition could cause catastrophe. So I think it makes people kind of walk on glass there.
Yeah. Like it's just they're spinning plates right now and trying to make sure they just stay upright. Yeah.
Well, yeah. And then inflation plays another, right, a huge part in it too. Right. And so I think that it's just how we get out of this. Like, again, this comes back to everything is like comes together.
Yeah.
Right. And it's just hard. Like, I don't know how they're going to manage all this. Like, there needs to be some sort of structural change there, but I just don't know if they can right now because of the situation that we're in. Right.
Yeah. I said that, we were coming to shit or get off the pot time, but I was afraid that they're going to start shitting while getting off the pot. And
well, I think
that's where we are.
The reverse repo, like I always look at it like it's a tool, like it's a toolbox or whatever. Yeah. And the reverse repo is the Fed's best tool, right? Yeah. Like that's their main tool. Like that's the one that no matter what is always staying in their pocket, because really they have control over the supply of money. Yeah. Right. I mean, that's what it is.
They're the De Beers carteling it. They're like reducing they know they've got all this hiding back here, but if they just trickle it out and they can maintain that supply of money, and they can just push inflation down, supposedly. Yeah. If they weren't also doing the plunge protection team.
Well, that's the thing too. So, and like those assets too that they're buying, so they're going out and they're buying, again, it's almost like the same thing they're dealing with like phase 6 here is like, hey, they want to go out and they want to buy high quality liquid assets, right? So they're going out, they're buying good stocks, they're buying things like that. Yeah. But again, with who knows, like the stocks that they're getting because of how people are playing positions and like the derivative markets and shit, like even if they're buying stocks, like who knows like how like strong really those stocks are, right? Yeah. Because of all the other shit that could actually be happening. Yep. So they're getting propped up on, Lord knows, like who knows? Yeah, it really is. It's hard to say.
I mean, just take a stock like Silicon Valley Bank. That thing was 360 day in, day out. It might fluctuate a penny for years. Then all of a sudden, blink. So it was an asset. People have been like, well, this thing's a stable as shit. Like I don't have to worry about this. I can have this in there. And all of a sudden, oh, it's not worth anything. And it's gone.
And it's gone.
Yep. So, and it was in a blink of an eye. Like it's just a day of trading, and it was gone. We don't see that.
No, on a big old bank, man,
no.
Especially one that all of Silicon Valley, all these startups and stuff, huge startups and like I said, that's all, again, I think that people can see the writing on the wall, and it freaked him out. I mean, at the core with what's going on with the banking stuff, I think a lot of it is it's at its core. It's like, hey, there's a bank run. They felt the liquidity stress. Like, we need to figure this out, and then boom.
Yeah.
I mean, the shit just hit the fan. There's a lot of different ways, I guess, to look at all this stuff. And I think that nobody's wrong, because I've been having DM conversations with people that are really passionate about this stuff. I don't think that anybody's wrong when they have or like not like straight up bold wrong, you know what I mean? Like I think everybody has a good idea of like what's happening here. And again, it's everything. There's a lot of contributing factors in this. And then I'm trying to think what else I could really add on the reverse repo. I mean, to be honest with you, man, I think that you kind of nailed with what that is. It's really, I think, just a control over the money supply, and they're riding that out as much as they can to avoid, having a collapse. So they're going to play that. Like, it's song and dance.
They'll play it, and then when we finally get, when unemployment goes to 6% and the housing market collapses and commercial real estate isn't worth shit anymore, then they'll be like, let that $2 trillion flood the market, and they'll start all over again.
Well, that's what happened. People will start buying houses again. They'll be flush with cash. They'll be loaning out money left and right. Yeah. It goes in cycles, really. History kind of repeats itself.
Then 2038, all over again.
That's pretty much true. Yeah. Another thing I had on my note list that I think is important too, actually, that we cover is because people have been talking about, like, hearing me talk about cleared and non-cleared. So I want to make like that distinction so people understand.
Lay it on us.
Okay, so right, we're understanding we're still talking about OTC derivatives, right? Which again are coming from stock, bonds, commodities, whatever, any sort of derivative that comes off of that. Clear derivatives are traded through a central counterparty, which acts as, like we were talking about earlier, kind of like, I guess, something I think that people would understand is like when you buy a house, like an escrow. That's kind of like how I would explain it, right? They take on, but although the central clearing counterparty, they take on counterparty risk, right? And they do that by taking high quality collateral, right? But they do this up front, as opposed to like the bilateral stuff where we're just kind of like we're talking about with uncleared, where me and you are just handling it. Again, it's that escrow person that's taking collateral from both sides. They're meeting in the middle, right?
Yeah.
So, and it basically just helps because if one party fails to meet their obligations, I guess is what I'll say, that the central counterparty is going to be there to make sure that there's no default that leads to some sort of catastrophe. I'm actually a big advocate of like thinking that everything should be centrally cleared. I understand that there's reasons why, like if I was a hedge fund, I wouldn't like it. Right, or like a fund or a bank.
I want to call up a dude and do my thing and not have to deal with anybody.
So I understand that part of it, but I just think that it would make sense to me, just from like over leveraged position, like people can get themselves in trouble. I think this is a good way to just like kibosh that, right?
Yeah.
So when you have things that are cleared, those are overall it's just less overall risk on the market. Okay.
Yeah, it'd be like when JP Morgan, we discovered that they had like 1 million tons of nickel that was just rocks in a bag.
Exactly.
Someone would be like, open the bag and go, this is rocks. There's no deal's not going through.
Yes, that's a perfect example. Okay. So that's where there's proposals for that to happen in the derivatives market right now, which is getting, there's a big war right now going on with that. But so that's basically what it means when something is centrally cleared. And then obviously, right, the inverse on something that's uncleared is basically where you guys are doing, this kind of like, on a handshake, you know what I mean? We're just kind of working. So that's what phase six adds a layer of this sort of, central counterparty into phase 6, right? Or I mean, not into phase 6, but into uncleared derivatives. So things that are not going through a central counterparty, they still have this level of margin requirements, because at one point, again, you were not having to post anything. You were able to just do business as usual.
Yeah.